Welcome to Street Talk, S&P Global Market Intelligence podcast that offers listeners a deep dive into issues facing financial institutions and the investment community.
I'm Nathan Stovall, and on this episode, we're talking about bank stocks, the sentiment toward the group, including concerns over margins in commercial real estate, and ultimately whether or not it matches the fundamental environment. Coming back on the show to share their view on those issues and others is Joe Fenech, Chief Investment Officer at Gen Opp Capital Management. Joe, thanks for coming back on the show.
Nathan, good to talk to you. Good to be with you again.
Joe, let's start at a high level of really what investor sentiment looks like towards the group. And it's been pretty dour, but we've seen it improve a little bit in the last few days. As you noted before we started this, it was kind of a dark tunnel. We're starting to see the light, but I'm kind of curious of what you look at, how you look at sentiment towards the group and what catalyst you see towards the sector.
Sure. So you're right. I think you hit it on the head, Nathan. It has been a long, dark tunnel, but we're seeing the light at the end of it. I think we're in a new investment cycle for banks. And in the early stages of a new investment cycle, any new investment cycle, really, sentiment's going to lag the performance of the stocks, right? So at least initially. So even though it hasn't felt this way, I think with some of the things that have happened over the last year or so, we're pretty confident that this bear market in bank stocks, this long bear market in bank stocks ended in May of last year. So it hasn't felt that way because most of the sectors continued to struggle with some things, right? Margin pressure. You had a big regional bank earlier this year that was teetering before private equity stepped in. You've had a lot of hand-wringing over commercial real estate. But look at the fact of the matter here is that the bank stock index is up nearly 40%, in line with the S&P 500 since last May. So, the stocks always bottom first, but the sentiment doesn't improve until the bad news starts to turn more positive. And we think we're right now at that inflection point where that bad news starts to turn more positive. So I'd maybe point you to a few recent developments. So I think when the retrospective of this cycle's written, it's not the bottoming of the stocks last May that's going to get the attention. I think it's the recap this year of New York Community Bank. So here you have, I think, by far the most challenged of the big regionals. And in comes one of the savviest investors in Steve Mnuchin to step in without government assistance to rescue it. So smart money comes in to save the sector's biggest potential problem. At the same time, the largest banks in the country are as healthy and as well capitalized as they've been in several decades. So that right there, I think, draws a line in the sand that says really there's no systemic credit problem, because you're not going to have a major credit problem without the involvement of the too big to fail banks. And when the biggest problem child in that next largest group of banks was just recapitalized by private equity. So, that event reminds me very much of the recap of Bank United back in '09. If you remember, Nathan, the stocks bottomed first in March of '09. And then a few months later, you have John Canis and Carlyle recapping Bank United. And then that paves the way for the recap of the sector, and sentiment slowly got better from there. This time around, the sector doesn't need to be recapped like it did then, but I think the Mnuchin investment will have a comparable effect to the Canis Bank United investment back then. So that's number one. Number two, I think we're at an inflection point for margin pressure for the industry. So we can talk more about this in a bit, but from a very high level, bank balance sheets today were built during a different time. Bank balance sheets today, I think, really reflect decisions that were made when interest rates were near zero, and the threat was that rates would go negative. Obviously, rates have gone the other way. There's a painful adjustment process that goes along with that. But for the vast majority of banks, that headwind's going to ease, if not this quarter, then next. And then it's going to turn into what I think will be a multi-year margin tailwind for the industry. So I think those are the newsworthy turning points, right? But then the specific catalyst that I think is beginning to get priced in as we speak is firming up the visibility to that first rate cut, right? So the gap between long and short-term interest rates is narrowing. The yield curve has been inverted for quite a while. But from where we sit today, just one rate cut's going to flatten out the curve. And I think that's the trigger for this group to really move higher. And investor sentiment, I think, is going to track that stock performance, but on a lag. And that'll provide additional fuel to the fire, right? So just some high-level thoughts. I know we're going to get more into the details of all that, but that's kind of how we see things from a high level, Nathan.
Sure, and I want to pick up on the margin piece, but going back to the NYCB recap and the comparison you made to Bank United, and one of the things that I've noted to people is if you look at where the capital markets were they were kind of closed for a lot of regional and community banks, and then that deal gets done. And to your point, that's one of the, that might have been the most troubled institution in that group. So to me, I've always touted that as a really positive marker. The capital was coming into the sector, and you've seen some deals come through since then too. I know you didn't point to that, but I think that that's a positive marker towards the group too, in terms of sort of drawing a line in the sand and saying that, we're moving forward from here.
I think you're exactly right. So, like last year, even though the stocks we think technically bottomed in May of 2023, new capital didn't come rushing in the door, right, to save some of the other institutions that were teetering at the time. The market healed some of them, and we just kind of limped along. So, I think you're right. You kind of need that high profile private equity investor. No one more qualified on that front than a Steve Mnuchin, right? And you had something similar happen with John Canis, right? When
Mm-hmm.
John Canis stepped in with Carlisle to recap Bank United, that was sort of the all clear for the recap of the sector. So the sector doesn't need to be recapped this time around, but I think sort of the effect is kind of the same, if you will.
Sure, sure. And we can get back to that later in terms of it. It could be offensive this time, but let's talk about the margin piece a little bit and the idea of margins bottoming. We've been waiting for that for some time. The question is, do rates have to decline? Do they have to decline materially for to see improvement? And I feel like I heard you say no in your mind, that some of this is simply time, that we need to see those lower yielding assets that were sitting on books turn over. Is that what you were getting at?
Yes. Yeah. So I think that visibility to that first rate cut, that'll help catalyze the stocks, but I don't think you need it necessarily for NIMS to bottom out. But it would definitely help, don't get me wrong. But let me maybe lay out where I think things sit for the vast majority of banks out there. So I talked earlier about this balance sheet adjustment process that's taken place, right? Let's say that rates just stabilize right where they are today. The pressure on the funding side maybe persists for another quarter or two, but then it also stabilizes, right? You're already seeing that. The challenge for banks in this adjustment process has been these longer term fixed rate loans and securities that'll reprice higher, but over a longer period of time. So take a well managed, well respected, medium sized regional bank like South State, right? They have $8 billion of fixed rate assets that will reprice higher in the 2 to 3% range. At 2%, that's 160 million benefit on a $40 billion balance sheet. So that's a 40 basis point improvement right there to net interest margin just from those fixed rate assets repricing over the time. So what are the risks to that playing out, right? Rates could move higher, which would further pressure the funding side, and at some point credit could crack, right? So those are risks. But your question was, do we need lower rates to help NIMS? And I think the answer is no. You just need rate stabilization. And so if you think about it, smaller banks tend to have higher concentrations of longer term fixed rate loans and securities, right? And if you stratify banks by size, the valuations are almost perfectly correlated to this sort of phenomenon, meaning the largest banks or the most asset sensitive have had the best fundamental performance. Those stocks trade right now at the highest valuations, and it literally stair steps down to where the smallest banks trade at the lowest valuations. And this, I think, is one of the main reasons why. So there's a lot of moving parts to that analysis, but the main point is that we're right now at that inflection point where this enormous headwind of the past few years begins to transform into what I think is like a multi-year tailwind now for margins.
Sure. And to that last point about valuation, I mean, maybe oversimplifying it, but regional and community banks in particular, make 75, 80% of the revenues on spread, right? So if that's a negative story, okay, we're not going to trade the group at a great multiple. We've seen that. I'm not saying it's justified, but just that's what we've seen. If this suddenly is no longer a headwind, then that has to be a positive for that portion of the group, right?
Yeah, it's a disproportionate positive to the smaller banks, and this goes back to my earlier point about the correlation to valuation. So, fee revenues have really started to pick up over the last couple of quarters. The larger banks derive significantly more of their revenue, as you know, from non-interest income relative to the small banks. So I don't think it's a coincidence that to this point, the banks that are less reliant on NII have been at a relative advantage, and those stocks trade at higher multiples. And that's another contributing factor to this wide disparity in trading multiples between larger and smaller banks. So, to the extent that you see NII stabilization and eventually growth, it's going to be a catalyst. And I think that valuation gap between large and small, which is about as wide as I've ever seen it in my career, that valuation gap should narrow from here.
And we've seen some of that in the last week, few days, where I've seen some folks on the sell side, attributing it to not even so much a massive change in the fundamental environment, but that trade sort of unwinding, maybe not completely unwinding, but easing a little bit, where you were heavily favoring the big guys because of this dynamic.
That's right. And the big guys tended to be the largest banks, especially a little more asset sensitive or a lot more asset sensitive, right? So as we get to that inflection point on rates, you're going to naturally see that rotation within the group. The small banks on average, very small banks are, before this week, are trading at book value, and the largest banks are trading at about 1.6 times book, and that includes Citigroup, which trades at 70 and brings that multiple down. So again, that multiple disparity has never been as wide as we see it today.
So I want to shift the CRE. I feel like we're getting so many questions. I'm sure you have lots of thoughts here, and it's been a overhang for the group. And I've made the case that I feel like there's a lot of lazy discussion on this, particularly from folks who are not in bank land. Everybody has decided they know every single CRE loan that a bank makes, and that the risk is massive. And ultimately, I'm just saying that we've made the case there's not enough nuance here. That not every CRE loan is created equal. Not every balance sheet is created equal. Not every market is created equal, and definitely not every subcategory. Do you think that's fair? Do you agree that there's not enough nuance in that discussion?
Absolutely agree. So, as I said earlier, let's just take talk of major credit problems similar to '08 just completely off the table. You can't have a major credit event without the involvement of the largest banks. Those banks are as healthy as they've ever been. And at the same time, private equities just recapitalized the biggest problem by far among the next tier of large regional banks. So, with that context, let's dig into the CRE thing a bit more. So, it seems as though every time there's been a stumble, like with New York Community Bank earlier this year, the Wall Street Journal runs a headline that references, 3.6 trillion of commercial real estate loans on bank balance sheets. The issue I have is in, like you said, treating that entire 3.6 trillion as a monolith, right? As some sort of giant proxy for risk. That 3.6 trillion consists of all the subsectors of CRE, multifamily, industrial, retail, and office. So let's right up front acknowledge the problem in office that primarily relates to the changes in how people work, right? Post COVID, particularly in the big metros. We see pockets of issues here and there in multifamily, but nothing alarming and nothing overly concerning in industrial or retail. So it's primarily an office real estate problem. And if you look at, research from the Fed, it shows that the larger the office space, the higher the default probability. So it's the larger office towers in the major metros. The big banks have most of this exposure, not because of bad underwriting, right? But because these are larger credits that even in the best of times don't tend to fit the risk parameters and are too big for the small guys. So if you take a Wells Fargo, Nathan, for 2 quarters now, they've said that this 11% reserve they have against the office book is sufficient to deal with the problem. In other words, they're not going to be adding to that reserve. Other big regionals haven't gone so far as to say the reserves have topped out, but their reserve against their office book also sits in the high single digit, low double digit range. So Wells Fargo has every incentive to tell the truth and not drag their heels on this issue. It's a single digit percentage of their overall loan book. They've got a mountain of capital. They've got strong and improving earnings. So there isn't any incentive to drag this out like there might be for a small bank that has a higher concentration of office loans and can't afford the earnings hit to take the reserve to where it needs to be. But Wells Fargo does. So if you assume their statements are accurate, let's now assume everyone has no reserves today on office real estate exposure, and you set everyone's reserves to match Wells's 11%. We don't have total office exposure for the industry, but if you look at the top 100 banks, that's a very, very manageable and absorbable hit. And then you consider, and I tell this story a lot. We have a bank in our portfolio in Wisconsin. They've got 40 office loans, no delinquencies, and their comment to us was that the largest building in the cities that they operate in is about as tall as a grain silo, right? And when you stop to think about it, about 80% of the country looks like the cities that this bank operates in. So the bottom line is that the scale of the problem in no way aligns with the amount of hand wringing that's taken place in the investment community. And so when New York Community Bank has issues with rent-regulated apartment lending in New York City, where a law was passed in 2019 freezing rents on rent-stabilized buildings just before you get in this period of big inflation, it just makes no sense to run a headline conflating that to the 3.6 trillion of total commercial real estate exposure that sits on, bank balance sheets around the country.
Right. And so not only is it not 3.6 trillion, when we talk about this poster child that they like to paint, that the folks who don't live in this space likes to paint the poster child of problems that is real, it's a fraction of it. And then to your point, the fraction that is there isn't even owned by the regional community banks because they don't have the balance sheet capacity. Even if they wanted to do it, they can't do those credits. And a lot of them not only exist with the big guys, but exist with CMBS, or they're tied up in CBS, or they're insurers or credit funds or whoever. So it's not that's just the office piece, but it's not really, we're not talking about actually who has the risk here. And something else I heard you say, if you think about what have we seen anything that really makes us feel better about this? It's that you're actually seeing the guys who do own this reserve pretty aggressively, and those reserves are not moving. We have seen delinquencies rise, but they haven't felt like they needed to lift those reserves beyond kind of those initial builds.
Yes. So take like a Citizens Bank, for instance, CFG, right? Similar reserve on office to Wells Fargo, they're about 10%. They've already taken 6% cum losses to date, right? So you're effectively got a 16% cum loss rate through the cycle on office, which what they said is that assumes a 71% decline in office property values, right? So you start to think about, you know, the bulkiness of these reserves, for lack of a better term, right? If the big banks are right, all you do is set everybody's reserve to that 10, 11% range. And when you do that, you see that the scale of the problem is in no way, big enough to sort of create or justify the angst and the hand wringing that's gone on about this topic.
Sure, sure. I'll talk about different, or I'll ask about different asset classes too. But one of the cases that I've kind of made is, okay, we do have a maturity wall here, and there's 2 points in there. One, yeah, the rates are significantly higher, but the asset, you need to do the homework and think about what the subcategories are there, and where they're located and all different kinds of things. But even if there's problems, I've been in the camp that this is an earnings problem. And where most of these guys are trading, they're trading. I don't know if you'd agree with this, but it feels like they're trading like there's holes in their balance sheets. And it doesn't feel like, and it doesn't seem like you think that that's the case.
For the vast majority of banks, no. I'm not going to say there aren't one-off issues out there, and I think we'll continue to see some of those. But again, if you're talking about a sector-wide problem and discounting the entire sector, I don't think that's appropriate, right? And where the meat of the problem sits is, again, with the biggest banks that are best equipped with the earnings power they have and the capital they have to deal with the problem. And it's a low single digit percentage of total loans at the banks where this is the biggest problem.
And the other thing too, I don't know how you think about this, but we have seen extensions, we have seen sort of pushed out over time, and maybe that doesn't sound very positive, but again, it allows them to work through it over time, opposed to this idea that I feel like you see all these headlines that everything's coming due this quarter, and then yet it gets kicked out a little bit further. I've kind of made the case that I feel like that if there is an issue here, it's not the issue they're presenting, but it's going to play out over a much longer period of time than a quarter or even many quarters. That it's not this huge waterfall event like it's been presented. I don't know if you agree with that
Yeah,
or not.
that's right. But I'm saying in a worst case scenario, even if it was a waterfall event and everyone's reserve has to go to 11% in one quarter, right, to deal with the problem, the scale of this office problem is not sufficient to cause sort of mass recapitalizations around the industry, if that makes sense, right?
Yes.
So then you layer in the fact of what you said, that no one's going to have to go to 11% reserve tomorrow in terms of the small banks, that this is going to play out over time. and it becomes even more absorbable. But I'm saying, even in a worst case scenario, you go to 11% tomorrow for the whole sector, it's an absorbable and manageable problem.
So you just laid out where you think the most bearish guys are wrong. Maybe said differently. I mean, I would ask you what you think they're missing. You've kind of laid that out, that they're missing, that this is not as big as of a threat, and that it's not going to happen as quickly or in as a short period of time. And there's other tailwinds from the margin side. Maybe asked differently, what do you think it takes to sort of get them to understand that this is not just the '08 playbook? Because it feels like that's where they're going back, is that they're like, oh, we've seen this before. Same thing 15 years ago. We know there's going to be this massive wave of defaults, and you've seen people even saying we're to see hundreds of failures and things like that. It doesn't really feel like that to me. Do you need to see just quarters of that not happening to kind of get them to understand that that's not the case?
Yeah, and there's a couple of data points and recent developments, I think, that kind of further that. So I think every quarter, to your point, that goes by where this notion of CRE Armageddon doesn't come to pass, and if we can bridge that gap to the first couple of rate cuts, that helps to provide some relief on that front also. I think in retrospect, 2024 and the second half of 2024 is going to prove to be the year of peak concern on this issue. And from there, it increasingly moves to a rear view mirror level of concern. So to me, it's really just a question of the passage of time without seeing problems on the scale of what we saw earlier this year with New York Community. Having said that, I think there's probably a handful more situations like we've seen recently with some smaller size banks where maybe regulators push banks with outsized CRE concentrations to raise some form of capital. Maybe a small bank here or there is caught with an outsized exposure and there's a dividend cut. But the angst and the discounting of the entire sector relative to the scale of the problem, I think it's way overdone. And in terms of specific developments that have been positive, Washington Federal Bank out in the Pacific Northwest just recently completed the largest CRE bulk loan sale ever. They sold, I think, just under $3 billion of mostly multifamily loans to Bank of America at 92 cents on the dollar. And the discount was not due to credit, it was mostly attributable to interest rate marks. And the CEO there, Brent Beardall, who I've known and respected him a long time, gave a pretty insightful interview on CNBC with his thoughts on why the whole CRE issue is overblown. I'd also point you to a recent M&A announcement, Nathan. South State, the bank I referenced earlier, conservative, extremely well managed, is buying Independent Bank in Texas. IBTX, 57% of the loan book at IBTX is commercial real estate. So South State, I don't think buys a CRE heavy bank like IBTX if management believes that a CRE crisis is right around the corner, right? So I think the data points are there for people that are willing to dive a little deeper beyond the headlines in the Wall Street Journal.
Totally. And those 2 points, the idea of it being a rate issue, those are two markers there. In the context of M&A, you have to mark a target's balance sheet to market. Well, while Fed's already taken the mark, no problem. South State too, they have the capital to take that mark. But if they really thought that it was a credit problem, they wouldn't be doing it. To your point, and I feel like we could see more clearing trades go if we see more M&A activity. And I'd love to get your thoughts on M&A. Really, in closing, like we've seen very few deals. A lot of it has to do with the required rate marks, some of it regulatory scrutiny, but it feels like the reasons to do deals are all still there. The push for scale, the idea that you want to invest more in technology, and the fact that you might have some balance sheets that are challenged on the potential selling side, simply because they have a lot of lower yielding assets on their books. Do you think we get that pickup in M&A activity? And if so, doesn't that have to be another catalyst for the group?
Yeah, I think what's been interesting about the M&A we have seen, Nathan, is that, you saw the deal in Michigan, right? You've seen IBTX, you saw the Heartland transaction with UMBF. What's interesting is that through all the stuff we've been through the last 4 years, franchise value has been preserved. I mean, all those deals were, over 1.5 times tangible book. So even through everything we've been through, I think that's point number one, is that franchise value has been preserved. But I think the M&A wave this time, and I think we're going to get it, but I think it's going to look different. So Tim Spence the CEO of Fifth Third, who I think is terrific, made a comment, I think, at a recent industry conference. He said that what '08 cost us was not only reputational damage, but it cost us a generation of talent coming into the banking industry. And I hadn't thought about it that way, but he's exactly right, right? If you're coming out of college
Mhm.
anytime in those years after '08, who wants to work in an industry that where you just had a financial crash, where the public and the politicians are just hammering you year after year? It just wasn't a sought after career for a long time. And I think we're paying for that now. So there's a major succession issue in the industry. The average age of a community bank CEO today is 62. The boards, as you mentioned, tend to skew older than the management teams historically. We've solved that challenge through M&A historically, but because of all the volatility of the past few years, there really hasn't been any M&A. So I think coming out of this cycle, you're going to have a whole lot of senior management teams that probably in a perfect world would have wanted to retire 3, 4 years ago. Now we are where we are. There isn't the talent in the organization to replace these people. At the same time, the regulatory environment's such that there aren't enough approved buyers, right? So it's going to be really interesting to see how it all plays out. I think there's no doubt there's a pent up demand for M&A, and maybe as soon as later this year it kicks off. But I just think it might look different than what we're used to seeing in the past.
Sure. And with valuations being with what they are, you talk about franchise value holding up, but on broadly, as we've talked about, you've got the bigger guys trading at higher valuations than the smaller guys. That seems like a nice setup for these deals, for the math to work on these deals, like eventually when that does come. But to your point, if it's a smaller pool of buyers, maybe you don't see a rush out of the gate.
Yeah, so I mean, back to I really like South State Bank, and I think they've done a nice job. But let's look at the acquisition they just did. You're getting access to great markets at a reasonable price. IBTX, I think, is trustworthy on credit. They just got a little upside down with too many long-term, low fixed rate loans. So to the extent that South State can rework that balance sheet, and as time just heals up some of those rate-related issues, they got a heck of a deal. So I think there's going to be opportunities as an investor like that to own some of the smart acquirers coming out of this cycle. And then I think you can own the sellers too. But again, I think you're going to have to take more of a rifle shot approach than we used to in the old days, right? I'm not as willing to own a company that underperforms fundamentally when the only upside I see is if the company chooses to sell itself, right? I think if you want to play the takeout game, you need to be comfortable owning the stock if the company never sells. And if takeout is part of your rationale for owning it, I think you have to have a specific thesis around how that potentially comes about. In other words, okay, there's value and scarcity to this franchise. There are potentially multiple buyers with the appetite and capacity to pay. And if you're really honest with yourself in that exercise, I just think that exercise is going to weed out more candidates than it necessarily would have in prior M&A cycles.
Certainly. Well, great thoughts. I certainly appreciate you sharing your views, and I know our audience does as well. Joe, thanks so much for coming on the show.
Great to talk to you as always, Nathan. Take care.